This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for opening gains after a wild week ended with Wall Street's best gain since 2023, but investors bracing for further volatility from Trump's fast-evolving trade policy. The president now warning that tariffs are coming for phones and consumer electronics, downplaying a pause as merely a procedural step. China, meanwhile, hiking its own tariffs to 125% while calling Trump's actions a joke and showing no signs that it's ready to negotiate. We're at the outlook for global logistics too, speaking exclusively with the DHL Group CEO Tobias Meyer.
Take a look at how Asian futures are setting up right now, pointing to the upside early in the Asian session as we continue to watch the offshore yuan holding at that 728 level against the U.S. dollar. Remember, 4 weeks of losses already for the Chinese currency, both onshore and offshore. We have seen central bankers, both from China, Korea, Japan, everyone gathering in Malaysia just to discuss these tariff implications for monetary policy. Nikkei futures pointing to the upside of 0.6%. We heard from Japanese officials saying that they will not be using the potential of offloading treasuries in these tariff negotiations going forward. Remember, there was a lot of speculation, of course, on what China might do with their purchases of treasuries that really spooked the treasury markets as well. And Haidi, we saw those losses last week when it comes to U.S. sovereign debt.
Take a look at how we're setting up when it comes to US futures. And of course, there are signs that this move upwards when it comes to US equity futures as a result of this idea of some of these exemptions. President Trump, of course, now pushing back against that narrative, saying that it's just more of a procedural step, that this could see that rally fade quite quickly. A little bit firmer. So we are seeing that relief that smartphones, electronics are being exempt at this point, that tariff stay applying. But it does look like they're looking at those supply chains, and that could very much impact the next move that we see ahead. We are looking at Asian stocks, though, as you say, particularly those electronics and tech-related names, seeing at least a boost in today's trading session. Let's get more on that top story. Bloomberg's Tyler Kendall at the White House is with us. Garfield Reynolds leads our Markets Live Asia coverage out of Sydney. Our Chief North Asia correspondent, Stephen Angle, is joining us out of Hong Kong. Great to have you all. Tyler, let me start off with you. What did we actually hear from President Trump in terms of these exemptions that he doesn't really want to be characterised as exemptions, and how permanent or impermanent could they be?
Yeah, so President Trump is saying that, quote, no one is off the hook, as it does appear that these tech imports will be subject to a Section 232 investigation, which could take weeks or months. So it's unclear how long that reprieve will actually be in place. We have to keep in mind the original executive order that President Trump signed on April 2nd always excluded things like chips, lumber, copper, pharmaceuticals, these industries that could be subject to Section 232 tariffs on the basis of national security concerns down the line. It now appears that these tech imports, including consumer electronics, will now fall under the umbrella of the sector-specific tariffs instead of the umbrella of the so-called reciprocal tariff plan. We heard President Trump saying that they're just moving these tariffs from one bucket to another bucket. Now, with that said, when this White House has invoked Section 232 before, including for steel and aluminum tariffs, on auto tariffs, they put into place a 25% baseline tariff when it comes to that. So let's say, just for the argument that potentially that could be the tariff rate that goes into place on these chips and these chip supply chain products that go into them, that would be lower than what they were facing, including that now 145% tariff across the board when it comes to China.
Garfield, we're already seeing futures moving higher early in the session. Could we expect a rebound in Asian assets as well, given that despite the fact that these tariffs exemptions might be temporary, the next batch of tariffs might not come for the next weeks or months?
Yeah, Shery, I mean, for Asia equities, there's two things that are going to drive them higher. One is simply the strong gains on Friday in US stocks, and although this morning's moves further in futures have been mild, the overall message for Asian equity traders is, okay, things have gotten a bit better, so share prices can come up. So that will be driving them. And along with that, the simple fact that however confusing the messaging might be, the message they will take away from all this is that when President Trump says, he's not backing away from these 145% China tariffs and from the reciprocal tariffs, that's not really the case. And whatever the president might say about things, for investors, the calculation is going to be that there are a series of pain thresholds that the president is not willing to go past. So therefore, that's going to reassure you. One of the big fears over the past couple of weeks was that Trump was going to impose these tariffs no matter what the pain delivered might be. That fear has gone away. Over the coming weeks, there is lots of scope for some of these gains to be taken away, because the reality of an extended and confusing series of negotiations and considerations and moves back and forth and tweets, that's all going to just emphasize how difficult it is for businesses to plan for ongoing operations, to plan for investments, and how much of a chilling impact that could have on the US economy and on the global economy. And if you think there's going to be that sort of impact, then I would argue that equities still look far too complacent, far too overpriced.
Steve, we're waiting for sort of more response from Beijing, but all indications seem that they're kind of digging in for the long run, particularly when you take a look at the pretty scathing rhetoric calling this trade war a joke. You know, if you take a look at the context of history and the fact that they are probably not going to respond to more tit-for-tat tariffs from this point.
Yeah, I think China is definitely digging in its heels and is going to essentially try and discredit the action so far from the White House on the trade front. There's been no indication that I have seen that they are, other than calling for talks on equal basis and with mutual respect, I've seen no indication that those kind of high-level talks are about to happen at any time. Even though Donald Trump says he's waiting for China to call, I don't expect China in this mood right now, in this environment, to actually make that first move. So we've had their reciprocal action as well. On Friday, we saw China increase their overall duties, tariffs on U.S. products from 84% to 125%. And you're absolutely right in that statement, essentially saying the action so far from the White House on the tariff front have been a joke, and that they're not even worth matching any further because they are a joke. But again, we did get a statement from the Ministry of Commerce yesterday, Sunday, in Beijing, when they had learned that there were going to be these exemptions, which are they exemptions or are they just recategorization? But essentially, they did call the exemptions on smartphones and laptops and the like on technology products. They said a small step by the U.S. towards correcting its wrongful action of unilateral reciprocal tariffs. And again, the Ministry of Commerce called on the U.S. to completely abolish its wrongful action on these tariffs. So they saw a sliver of hope. And keep in mind, of the bilateral trade between China and the United States, it's smartphones, it's laptops, it's lithium-ion batteries that make up the largest proportion of trade to the United States. So that exemption, whether it's temporary or not, was welcome news in China, but it just means you're kicking the can down the road until they find out what kind of tariff is going to be on those products.
Also welcome news for U.S. business leaders, right, Tyler? I mean, what was the reaction coming from these American business leaders that were looking at these tariffs, and now they're getting a little bit of a reprieve, at least when it comes to the deadline of when these will be implemented?
Exactly. It gives a little bit more room, particularly when it comes to negotiations. And to the last point that was made, there are still these big questions about how long the reprieve will be, but also how far will these tariffs actually extend when it comes to the scope of these products. For example, will this White House look to a tariff based on the value of an iPhone in total, or will it just tariff based on the chip inside of the iPhone? It's things like that that's going to make a real sizable difference for these companies, when they are looking at their supply chains and start to try to seek carve-outs and more exemptions from this White House. And particularly when we are talking about how this potentially could, based on history when it comes to the Section 232 tariffs, be a 25% tariff in place, that would be seen as at least an initial victory for big tech companies because it is so much lower than it could be. But really, by and large, we've already seen tech leaders come to the U.S., chip makers, come to the White House, chip makers come to the White House and really try to seek these exemptions. Even Tim Cook, for example, donating to President Trump's inauguration fund $1 million in a bid to try to get ahead of all of this, even as we start to see them move forward. So we're really going to be looking to see what sort of other meetings are put onto the White House's docket as all of these questions start to try to get answered by these companies about how exactly will this White House move forward when it comes to these tech imports.
Geoff, we've got a great piece from Shery. We'll be asking her about it, but it essentially poses a question: why wouldn't China at this point consider weaponising the $760 billion arsenal of Treasury holdings, particularly as, and you may agree or disagree, that seems to be why Trump blinked?
Well, for one thing, it would create a lot of difficulties for for China. Unless we are moving down a path towards a world in which treasuries are less of a haven than they were. But they're still, they still have those characteristics. It's a very deep market. You can unload them readily enough without causing yourself losses. And when it gets right down to it, the Chinese system is set up to essentially control where its currency goes against the US dollar. So in that case, it kind of doesn't make a huge amount of sense to put your money in something other than treasuries, because, or too much of your money in something other than treasuries, because you're probably going to need treasuries, either buying them or selling them, as a way of carrying out what you need to do. I think for the moment, China's probably well enough suited having that potential leverage to wave around rather than actually using it. To some extent, the US is doing China's job for it on that front because they've been busy making it clear they don't like to see the US dollar too strong because everybody's holding it as reserves. So, for everybody who's holding it as reserves, as they're buying gold, as they're perhaps buying the euro, buying the franc, that's delivering the fallout of suddenly higher treasury yields, which can act to scare. One of the few things that seems so far to have acted to seriously scare the president. And if China was to take that step, I think it would also, it would remove some of that leverage. It's always better to have it rather than to use it. But also, it would deliver a lot of pain to a lot of investors worldwide, not just to the US. So again, it's China's playing for the long term here. So does it want to annoy investors on that front by carrying out a sort of precipitate action that would cause a lot of not just investment pain, but economic pain? I mean, if you think that last week perhaps was fueled by China, offloading a little bit, or there are rumors of it doing, if China was to come out and say, yeah, we're selling $200 billion of treasuries, where would US yields go then? Above 5%, probably towards 6% potentially. The Fed would have to step in. We've already had a lot of damage done to global markets and to the global economic outlook, specifically by what Donald Trump has done. So why should China kind of put itself in the frame as also being to blame on this?
Yeah. Actually, President Xi Jinping really trying to portray itself as a collaborator and as a global leader as well. Stephen, we know that President Xi Jinping is headed to Southeast Asian countries.
Yep. Yeah, and he's going to key ones that were targeted by Donald Trump. He heads to Vietnam today, which before they got the reprieve a week or so ago, they were tagged with a 47% tariff by the United States. Then he heads on to Malaysia and Cambodia. Cambodia had a 49%. Malaysia, I believe, was 24%. And these, at least two of them, Vietnam and Malaysia, are also secondary suppliers and makers of Apple products. iMacs are made in Malaysia and Vietnam, as well as other products. So that's just a side interesting story to why Xi Jinping would choose these particular countries to try and court them as well to do more business to what Xi Jinping is trying to portray as a more open and multilateral government in Beijing, as opposed to the unilateral protectionist government in Washington. So he's obviously taking this as an opportunity to shore up support support with neighboring countries in Southeast Asia at a time of great uncertainty with the United States. Not a surprise. Over the next, this week, Xi Jinping will be making some headlines out of Southeast Asia.
Yeah. Bloomberg Stephen Engel, Tyler Kendall, and Garfield Reynolds, thank you so much for all of those insights. Of course, we'll continue to discuss these tariffs. Later on Bloomberg Television, we'll be speaking live and exclusively with U.S. Treasury Secretary Scott Bessent during his visit to Argentina. That's coming up at 4:45 p.m. on Monday in New York, 4:45 a.m. Tuesday in Hong Kong and Singapore.
And still ahead, Shery, on the Asia trade, the former Australian ambassador to China, Geoff Raby, is along with us to talk, give us his take when it comes to how Beijing is positioned amidst all of this. The Brookings Institution unpacking how the fusion of economics and national security has set the stage for those tariffs. Plus, we'll be speaking to DHL about how the trade war is impacting their outlook, demand, and an exclusive interview with CEO Tobias Meyer. Much more ahead. This is Bloomberg.
We certainly need to have semiconductors and the downstream electronics supply chain move to the United States. What happened is, it's not really an exception, that's not even the right word for it. What happened is this type of supply chain moved from the tariff regime for the global tariff, the reciprocal tariff, and it moved to the national security tariff regime, where we have studies ongoing for pharmaceuticals, for semiconductors, metals, etc. So it's not that they won't be subject to tariffs geared at reshoring, they'll just be under a different regime.
US Trade Representative Jamison Greer, they're talking about the Trump administration's plans for tariffs on electronics. Joining us now is Geoff Raby, who's a former Australian ambassador to China and the chairman of Geoff Raby and Associates. Geoff, always great to have you with us. And the interpretation of what we've seen over the past couple of days from President Trump has been interesting, right? He's pushed back saying it's just procedural steps. A lot of people perceive it as he's sort of looking for an off-ramp, given what's happened on markets and across the Treasury markets as well. How would Beijing be perceiving this, given that they've essentially said, we've matched to 125, we're not going to go higher than that because, in their words, this is a joke?
Yeah. Well, I think they'll be concerned about the chaotic state of US policy with this respect. The one thing the Chinese leadership dislikes more than anything else is uncertainty and instability, and this has injected enormous uncertainty and instability into international markets. And so I think they're preparing for the long haul. I mean, Chairman Mao had a slogan for preparing for war: be patient, gather your people, and prepare for the long run.
Is that what they're doing in terms of looking within the gaps and the divisions now being created internationally by Trump policy, whether you're talking about trade policy or foreign policy more broadly, to look for those opportunities where Beijing can take that leadership role?
Yeah, but it's not just in the last 2 weeks or even since 20th of January. I think we've talked about this before on this program. China has been building, if you like, its own international bounded order for a very long time. Partly it's to build resilience against this, because after all, we forget that Biden did not repeal any of the Trump tariffs against China, nor did the Biden administration do anything to fix the damage that Trump did to the multilateral trading system, the WTO. And I think China's been preparing for this for a long time, and we see it, for example, in the BRICS. That's led by China, originally a grouping of Brazil, Russia, India, China and South Africa, but now there's 14 countries have joined, and there's a long, long suite of countries who've got their hand up to become members. So this is all part of China building its resilience against these sorts of contingencies.
You've, of course, including in your latest book, Great Game, written at length about the positioning of Russia and China, both, of course, old friends and rivals in a lot of respects. How would Putin be looking at all of this? Because there's been a lot of, obviously, commentary that, Russia obviously hasn't been targeted by tariffs, and, they're sort of sitting pretty in a lot of ways.
Yeah, Putin probably thinking, how can anyone do so much self-harm? I think they would find it extraordinary. And it's very interesting. Why has Russia been left off the list? It doesn't make any sense. OK, they're subject to heavy sanctions already because of the invasion of Ukraine, but there's still, the symbolism of it is all wrong.
I mean, It's interesting that we continue to see this move towards self-reliance, towards resilience, right? From both sides, Washington and Beijing as well. But Ambassador, in this sort of effort to reorder global trade, is it inevitable and sort of essentially the fact that both countries are headed towards preparing for a potential war? And if that's the case, what are the likelihoods of really having a military conflict at some point?
Well, the thought of that is horrendous. I did see some clip of Trump referencing US capacities of weapons, but it is a worry. Look, the WTO and the GATT system before that gave the world more than half a century of peace. There hasn't been a war fought since that system was created over economic or trade matters. So this would be an extraordinary development in world affairs, and I don't think we're anywhere near that myself.
How would Washington be positioned at a time when we are seeing it really have more conflict with its traditional allies and partners?
Yeah, well, what I think we're seeing is very much a strategy of America returning to its hemisphere, the Western Hemisphere, focusing on its immediate region, Greenland, Canada, the Gulf of America. All of that points to a United States under this presidency which is going to be less engaged and less involved in global affairs.
It's interesting, we had that op-ed from Xiao Qian, of course, last week, just a few years after Beijing's own trade tiffs with Australia now wanting to sort of join hands. Is this part of the reality check that, you know, Canberra, but also other US allies need to be facing at the moment in terms of not just this administration, but how does this carry on into future US administrations, and does that reshape the nature of global alliances?
Yeah, well, very, very a good question, and something that I've often talked about with others. Former Prime Minister Paul Keating's very much of this view as well, that Australia makes a big mistake if it places its entire security on the assumption of the reliability of the United States. And I think in many ways Trump has done us all a favour to make us look at those underlying assumptions which have been sort of deeply ingrained in our psychology, but now with a rude shock we have to ask ourselves, how reliable is the US as a ally and as a partner? And I think that's going to lead to a rethinking of relationships and alliances around the world. I mean, you know, if you're in Japan or South Korea, you know, and you're so close to China, you have to think again about how you've put so much weight on the US security guarantee and whether that can be relied on if push comes to shove.
Geoff, always great to have you with us. Geoff Raby, who's a former Australian ambassador to China and chairman of Geoff Raby and Associates. More to come here on the Asia Trade. This is Bloomberg.
U.S. futures pointing to some upside early in the Asian session. This, of course, after the best week since 2023 for the S&P 500, which jumped on Friday after a report that the Fed is ready to help stabilize markets if needed. So with that potential Fed put at play, we'll continue to watch Asian assets as we're also seeing Asian futures pointing to some upside. This is Bloomberg.
As a result of all of these renegotiations and these new trade flows and fiscal policy, that new normal is completely out of the central bank's control. We cannot affect that. All we can do is keep inflation expectations anchored and try to manage some of the ups and downs on that journey. But that destination is up to the executive branch and Congress, not the Fed.
Minneapolis Fed President Neil Kashkari on the central bank's view of the global turmoil, and central bank decisions are in focus this week amid the global market mayhem. Singapore's Monetary Authority could ease policy settings when we get its decision in the next hour. On Thursday, the ECB widely expected to cut its key rate. Economists also think that the Bank of Korea this week will stay on hold. Some key eco data out of China this week, with March trade numbers due out today. Bloomberg Economics says Wednesday's first quarter GDP print could show growth slowing. March March activity numbers highlighting uneven performance when it comes to key drivers. Take a look at what we're watching when it comes to global bonds, and of course this has been such a crux of where we see the global volatility, right? Particularly over the question marks over the trading that we've seen in treasuries at the moment. We've seen broader US futures rising, of course, after that pause on tech tariffs and some sort of calm also returning to the treasury market there as well when it comes to that longer yen 30-year futures for treasuries falling with those electronics and smartphone tariffs and the potential exemption, or at least a little bit of a pause there. Being in focus there. We're seeing longer maturity treasury futures just declining after the pledge to apply tariffs on some electronics despite a temporary exemption there. So we've seen a loss of almost about 2.5% for treasuries in the last week. That is the biggest slump since 2001. And Shery, this is kind of being seen as one of the reasons why we're seeing the White House perhaps more concerned about market stability now.
And of course, that market instability that we're seeing in the broader markets affecting emerging market assets in particular. We're talking about right now emerging market stocks having risen to a 5-month high, but the likes of investors and analysts saying that they're pretty pessimistic about where these assets will head in the next few months. Goldman Sachs even saying that the dollar unwind that we're seeing right now, and remember the dollar now falling to a 6-month low, and we continue to see the downside in the early Asia session, that will support exchange rates in other big developed countries, but not necessarily emerging markets. And of course, we're watching Latin America very closely. They're also affected by these Trump tariffs. And we're focusing right now on Ecuador. Exit polls are now showing that the incumbent president, Daniel Noboa, won Sunday's election runoff with 51.2% of the vote. A win for the Trump ally against his socialist opponent could potentially trigger a rally for Ecuador sovereign bonds. Bloomberg's Latin American executive editor, Creighton Harrison, joins us now from Mexico City. Creighton, of course, credit markets could rally, but at the same time, we're watching this election very closely for any indication of perhaps if we're going to get some anti-American sentiment because of President Trump's tariffs.
Yeah, absolutely. That was one of the big barometers here. You know, Noboa has really aligned himself, and even in recent weeks, he flew up to Florida and met with President Trump at Mar-a-Lago, informal meeting, but he made sure that everybody knew he had done that. He's also talked about even some military cooperation with the United States, perhaps hosting troops again. They used to have some bases there. They got closed a few years ago. So he really wrapped himself not only in the Ecuadorian flag, but the American flag. And, you know, the early signs are that it may have been just enough to work. This was a very close race. The exit polls have been a little off in the first round, so we're still exercising a little caution on declaring victory for either candidate here. But the early results would indicate he's headed toward victory, which would be a very big deal, both for an endorsement of his ties to the U.S. and his security strategy to crack down hard on crime in Ecuador, which has risen quite a bit in recent years, and also a big deal for bond investors, as you mentioned.
Tell us a little bit about the credit markets, because, of course, that had implications for Ecuador's bonds and debt, just broadly speaking as well, given, of course, the economic issues in this country, especially the rise of violence in recent years, really affecting the broader economy as well.
Yeah, exactly. I mean, it affects everything from trade to tourism, you name it, right? So it has been a major factor. Now, Noboa, you know, he's only been president a little more than a year. He was elected in a special election after the last guy quit. So he's had just a short time to start to implement his policies, but he did get a deal worked out with the IMF. Which now, you know, his opponent has talked about getting rid of that deal or taking steps away from it at the very least. So if that is secured with this victory, that will be a big deal for the economy. He's also at least made some progress on the budget, maybe not as much as investors would like. But the bonds had rallied quite a bit right up until the first round of the election, where he did not perform as well as expected, and they have tanked ever since. The investors we talked to the last couple of days said they thought that that a victory for Luis Gonzalez, his opponent, was priced in. So we are looking for a big rally in the morning if this result holds.
In the meantime, we're seeing the US Treasury Secretary Scott Bessent set to meet with the Argentinian president early this week. Why the focus for the White House in this area, particularly at a time when, of course, there's plenty of policy chaos going on at home?
Yeah, absolutely. No, you have Secretary Bessent flying to Buenos Aires. He'll be there tomorrow with President Mireya of Argentina. And you also, of course, have Nayib Bukele, the president of El Salvador, at a working visit at the White House. So very, very high-profile meetings between the White House and Latin American leaders. And you can see, I mean, these are obviously two leaders who are sort of philosophically aligned with President Trump. Bukele, of course, has been accepting deportees into his prison that the U.S. has said, despite not offering a lot of evidence, are criminals. And then, of course, Milei is very much aligned with the sort of Elon Musk chainsaw. Let's cut first and ask questions later sort of philosophy. So they're very much hand in hand. But this is also part of, the White House has been very, very active in Latin America, and a lot of people would say a lot more than the Biden administration was during those 4 years. And there's an attempt here to sort of force the hand of some of these countries and choose who their partner is going to be. Is it going to be the U.S. or is it going to be China? You can look at Argentina in particular, where the State Department has been putting a little pressure on President Milei and saying, do you really need an $18 billion currency swap to finance yourself from China when you could be friends with us instead? So that will be one of the many points that I'm sure Secretary Bessent will bring up during his visit.
Bloomberg's Latin America Executive Editor Creighton Harrison there with us as we see this sort of diplomatic outreach continue at a time where, of course, we have seen extraordinary levels of volatility when it comes to these markets, and really no corner of assets has really been unscathed. Take a look at how we're tracking when it comes to commodities at the moment, which, of course, when it comes to things like oil demand, have really been badly hit by this ongoing trade war, despite the changes when it comes to some of the policies that we've seen. We're seeing oil trading pretty steady at the moment after the tariff reprieve, or what the market is seeing as at least a temporary tariff reprieve. We're seeing that crude has been ticking a little bit lower at the moment. At the moment, we're seeing off by just about 0.2%. Really, the impact of the tariff exemptions for electronics, as well as ongoing weekend discussions that were marked as constructive between the US and Iran there as well. So these punitive levies have really been weighing heavily on the likes of crude. A little bit upside there when it comes to copper prices at the moment. And interesting, we are seeing a little bit of sort of a pause when it comes to this rally in gold as well. More ahead on the Asia trade. This is Bloomberg.
We're waiting. The Japanese market opens in about 20 minutes time, but take a look right now at how we're trading when it comes to the setup. The Japanese yen has really continued to strengthen against the U.S. dollar in the last few days, so we are seeing it really gain towards that 143 level against the dollar. Right now, weakening slightly towards 144, as Nikkei futures are now setting up for potential gains, with futures trading more than 1% higher. We are watching JGB yields as well. Of course, we have seen the huge treasury sell-off last week. We'll continue to discuss what could happen with those tariff negotiations. Japan and the U.S. Due to begin trade talks later this week. Prime Minister Ishiba seeking an exemption from the so-called reciprocal tariffs that went into effect on Japan last week. Let's bring in Bloomberg senior editor Brian Fowler. Brian, I was mentioning how we saw this huge treasury sell-off last week, and there was a lot of speculation whether perhaps the purchases coming from China or some other treasury holdings from other governments could really be put on the negotiating table and used as leverage against Washington. Japan is now saying they're not going to do that.
Yeah, so, I mean, Shery, Japan's position in the market is more than $1 trillion in treasuries. It's the biggest in the world. China's at $760 billion. So those are huge holdings, would have a huge impact if they wanted to start selling those treasuries or threaten to do so, because the U.S. fiscal situation would be in a bad situation. However, the LDP policy chief said pretty clearly that Japan does not plan to use its treasury holdings as leverage, and that's consistent with all the messages we've seen from Japan thus far, not only in terms of treasuries, but also Japan has said very clearly it's not going to retaliate with new tariffs. And that's important because we had a survey over the weekend from Kyoto that showed that more than 80% of Japanese households are really concerned about the tariffs having some kind of impact either on jobs or money, income or whatever. But it's important for the Japanese government to try to win some kind of exemption or at least some sort of softening of the tariffs.
What is Japan looking for in these talks this week, right? What's kind of been the mood music been?
Yeah, so I mean, they would like to see the so-called reciprocal tariffs taken away from Japan, and they also are really intent on trying to get some kind of relaxation of the duties on autos and auto parts. That's a huge part of Japan's economy. 8% of the workforce is involved in the auto sector in one way or another. So that's a lot of jobs that are at stake. So I think that's going to be the main thing, is to look for, even if it starts with a temporary rollback of those tariffs on autos, I think that's going to be the first thing they're looking for.
At the same time, of course, we are expecting perhaps that extra budget here in Japan. Is that going to help the economy?
Yeah, so the extra budget, I think it would look at two things. I think partly it would be looking to address the impact of tariffs, and that might be funding for companies that have been affected by the tariffs. But then the other part of it's going to be an effort to mitigate the impact of inflation on households. So we'll probably see a continuation of subsidies for utilities. That's been big. We could see cash handouts. In the past, that has not tended to really boost spending, but on the other hand, I think nobody complains about having some extra cash, so that could be another part of it. But yeah, we would expect to see more details on that later this week.
Brian Fowler, always good to have you with us. Bloomberg senior editor on these U.S. tariffs and the meaning for Japan. Let's delve into these levies. Our next guest says the fusion of economics and national security has given U.S. presidents freer rein in imposing trade restrictions. That allows President Trump to amp up the use of tariffs as tools of coercive diplomacy. Let's discuss this with Mireya, Solis, research director at the Center for Asia Policy Studies and Knight Chair in Japanese Studies at the Brookings Institution. Great to have you with us. I mean, what a time that we live in, right? Where we're actually discussing perhaps de-risking from the United States itself. I mean, how unusual is this scenario right now, and what can countries do at this point?
I think well, first of all, it's wonderful to be here with you. I think we're at the beginning of a new international economic era, and every country is out there trying to figure out what that means for them. For a long time, we have seen this trend where as the geopolitical situation deteriorates and the United States and China consider each other strategic rivals, we began to see that fusion of national security creeping into how governments think about what should be the rules for the international economy. And for a long time, the United States has been trying to build trust with its allies, Japan, South Korea, and many others, in thinking about how we minimize vulnerabilities vis-a-vis China. Now comes the second Trump administration, where you have a superpower that actually now is saying that he wants to be repaid, and therefore that he wants to rebalance every single trade relation, and that is going to use the market power it enjoys to set the terms of trade differently. And that's where I think the tariffs come in. And this is a huge shock to the Japanese economy. It's a huge shock to all our Asian partners, because these reciprocal tariffs were set at a very high level, but also because you have a tsunami of other tariffs, with the auto tariffs, with the metal tariffs, with the universal tariff. And then this brings, I think, a crisis of many layers for Japan. You have the economic shock that you were discussing just a few minutes ago. You have the challenge of U.S.-Japan alliance management, because Japan depends on security guarantees from the United States. It wants to make sure that trade friction does not chip away at that alliance bond. You also have for Japan concern about the future of the multilateral trading system, because Japan depends on unfettered access to global markets. And this comes at a time where domestic politics in Japan are tricky, and we don't know if Japan can rise to the occasion like it did with Prime Minister Abe and chart forward a new path where it maintains ties with the United States and de-risks at the same time.
When it comes to minimizing the vulnerability to these tariffs, is it imperative for these third-party countries to do so for both the United States and for China? And what would the choices be for countries like you mentioned, Japan, for example, when I just discussed with my colleague that they're not going to use perhaps Treasury holdings as leverage?
Japan has stayed away from retaliation, and Japan is a status quo country that believes in the stability of the international economic system, both in the trade arena and the financial arena. So that's not the route that Japan is going to take. Japan is going to take, first of all, negotiation, and you have now that person that Prime Minister Ishiba has designated, Minister Akazawa, coming to Washington this week. And this is going to be very interesting to watch because I would say that Japan and the United States have been negotiating trade for decades. And some of these negotiations in the past have been very tense, but we never really have encountered the type of negotiation that we're now about to witness, where the United States is using these coercive, so-called reciprocal tariffs. It is trying to open negotiation fronts with scores of nations at the same time, and we're very willingly might link not only trade issues but also security issues. And it would not be a surprise, I think, that Japan may be asked to do more in terms of defense burden sharing, that currency issues might also be linked to these discussions. And I think we need to see how Japan manages that set of inflated demands from the United States. But the other thing that I believe Japan should be doing, and it did some in the first Trump administration, is to begin to diversify its trade relations even more. And you know that Japan rescued that very important trade agreement, the Trans-Pacific Partnership Trade Agreement, at the time of the first Trump administration. I think that we now need to see a relaunch of that level of ambition, and perhaps Japan and the EU and other countries that still believe in this predictable, rules-based trade, they could gather and try to push forward, given that there's going to be a lot of turbulence in the U.S.-China relationship, because what we've seen in the past week is that they're playing a game of chicken with these very rapid tit-for-tat in tariffs that now have reached prohibitive levels.
So the commitment or recommitment to multilateralism you think we should see just with other trading partners, right? Some of them obviously would be easier. You've mentioned the EU. What about that relationship with China, though? Because economically, it obviously makes a lot of sense in many ways, but for a lot of these other middle country neighbours, it's also an uncomfortable relationship.
Yeah, so, you know, this is a balancing act, and Japan very much depends on a healthy, robust economic relationship with China. There has never been an intention in the part of Japan to decouple, because Japanese companies depend heavily on access to the very vast Chinese market. So it's always been about, and Japan has become a leader in recent years in the field of economic security, to identify, to map out supply chains and identify areas where there is vulnerability, where there is overdependence, where a lot of, you have concentrated supply in very sensitive commodities, and it all traces back to China, and then begin to think about how you build alternatives to that. That takes time. And the problem with this rush from President Trump to impose tariffs like this, and then China to retaliate so quickly, is that we're also now hearing that China, like it has done in the past, is again restricting the export of very critical materials at a time when the United States has not built up sufficient alternatives, and Japan is not yet fully prepared either. So I think that what Japan would like to do is to make Japan-China economic relations stable, functional. They are members of a regional trade agreement, and therefore there's a lot of opportunity there to conduct some trade. But when it comes to the sensitive technologies, when it comes to critical minerals and choke points in the supply chains, I think that Japan is looking to build alternatives. And the other thing that you mentioned, multilateralism, in the negotiations with the United States, I think it would also be very important for Japan not to agree to any concessions that would go against the WTO rules, because they would end up undermining a system that still very much is to their benefit. Because I think this day and age, what we're going to learn very quickly is that when you lose predictability, when you don't know what the tariff rate is going to be from morning to afternoon, we really want to latch to those norms and those rules that gave these companies a sense of how they can navigate these turbulent times.
Mireya, Solis, good to have you with us. Research Director at the Center for Asia Policy Studies and Night Chair in Japanese Studies at Brookings Institution. And of course, you can catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo. Subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. Take a look at some of those stocks that we'll be watching at the open in Korea, Japan, and Australia. Of course, tech stocks very much in focus, given that we got that late Friday reprieve exempting a range of electronics from that 125 tariffs on China, 10% flat rate around the world. But at the same time, afterwards on Sunday, after a round of golf, President Trump pledging to eventually apply those tariffs, that this is a temporary exemption and it's just a procedural step. So what will that mean for these names across Asia, semiconductor makers, just big tech hardware companies? Haidi, those are the moves that we'll be watching in today's session.
Yeah, and just taking a look at how long this kind of boost to risk appetite potentially hangs on for, given that we have seen President Trump really trying to talk down, saying that the tariffs are coming when it comes to the targeted electronics sector. That has been the source of a little bit of a reprieve, and we do see that sort of upside when it comes to US futures at the moment. It does look like we'll get some of that benefit when it comes to the Asian session here. We're seeing a little bit of upside there for the start of trading here in Sydney. Nikkei futures also a pop of 1.5%. S&P futures still holding on to most of those gains there at the moment. So even a temporary reprieve at this point, but volatility is certainly expected to continue. There is just this growing theme of that loss of confidence in US policymakers, and that's spreading to that loss of confidence across US assets, right? Continuing to feed into dollar weakness, that rise in long-dated treasury yields as well. The focus also today will be on China and Taiwan tech, as well as central banks, including Singapore today, the ECB later this week, Korea, all on watch. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, and we'll be watching reaction broadly in the markets, especially in the technology sector, to that exemption that we got from President Trump on electronic goods. Of course, that exemption, though, he's clarifying, doesn't mean that it's over, Haidi, that in fact they will come in, but that these exemptions are just procedural. But still, we're talking about those tariffs from 125% on China to 10% flat rate around the world being halted for the time being.
Yeah, downplaying that as a procedural step, as you say, Shery, perhaps not wanting to feed into this narrative that it is sort of looking for a ramp down when it comes to these heightened trade tensions and the way that they've really played into the US asset sell-off, right? Particularly worrisome for the White House when it comes to what we've seen across Treasury markets and just the chaos and confusion.
Yeah, and you can see right now that we're seeing broadly markets reacting positively to that exemption when it comes to electronic goods. You can see the Nikkei gaining more than 1%. The Japanese yen also holding steady at that 143 level against the US dollar after strengthening in the previous session. We're seeing also the Kospi, which will come online very shortly. We are expecting some reaction there, given that, of course, Samsung, SK Hynix are all semiconductor makers that we're watching very closely in this session.
In terms of that reaction to the global trade war, Shery, we're seeing that response from Singapore, from the Monetary Authority of Singapore. They're cutting reducing the slope of the currency band. Just a reminder for our viewers, of course, the MAS doesn't rely on interest rates as its monetary policy tool, but it uses the exchange rate to keep price growth price growth, I should say, in check there. We're seeing some commentary there when it comes to keeping the width of the currency band there, but reducing the slope of the currency band. When it comes to the 2025 GDP growth estimate is being cut to between 0 to 2% from the prior 1%. We've seen the first quarter GDP rising 3.8%, missing expectations of 4.5%. But when it comes to that policy reaction, the MAS reducing the slope of the Singapore dollar band, keeping the width and the centre though. So as expected, Singapore was expected to ease those currency settings in response to these ongoing build-up of tariff risks. Interestingly, though, we did have some economists, including Bloomberg economists, believing that they were going to sort of perhaps wait and see to see the true impact of these tariff settings and potentially further retaliation and what would happen when it comes to global trade disruption, given that Singapore is such an externally vulnerable economy when it comes to trade. But we are seeing that move when it comes to the MAS, reducing the slope of the Sing dollar band but keeping the width and the centre, Shery.
And you can see really the language coming from monetary authorities in Singapore, right? When it comes to output seen below the economy's potential this year, talking about downside risks to Singapore's economic outlook. Also, as you mentioned, Haidi, really the downgrade when it comes to growth forecasts to an estimated 0 to 2% from a prior 1 to 3%. So not surprising that we got this action from MAS. And of course, we had already seen the outlook for core inflation looking pretty benign, and MAS now saying the core CPI's forecast to stay well below that 2% level. You can also turn to your Bloomberg for more analysis on Singapore. Go to TLIV Go to get your commentary and analysis from Bloomberg's expert editors.
Yeah, output seen below the economy's potential this year, the external environment remaining uncertain, according to the MAS there. And the view is really that Singapore's economy will be significantly impacted this year with that risk of recession. Let's bring over our next guest, who's been reducing US exposure since before the tariff announcements earlier this month. Mark Matthews is the head of Asia Research at Julius, Baer, and joins us now from Singapore. And Mark, given that we've just had that MAS announcement, I did want to get your views on, is this a sort of expected, almost preemptive reaction that we should be seeing from other central banks, particularly ones from very trade and externally exposed economies? Or would you think that there would be a little bit more wait and see, potentially even further step downs from President Trump?
Very hard to know what the direction will be because we just had Commerce Secretary Lutnick and the president himself saying these exemptions are not temporary. We will have permanent tariffs. And so it's a ping pong ball. It's not being very well executed, but you never know what they could say at the end of this week. I think last week, what was encouraging in a strange way, if you want to make a positive out of a negative, is the bond market forced a reaction from the White House. And so it might do that again. And so may other markets like the currency market and the stock market. And so it may be that that tariffs that appear to be permanent now actually do become not permanent over the long term, but we don't know. And so in the absence of any certainty, I'm not surprised that central banks want to try to help economies along, because it does look increasingly likely like the largest economy in the world is heading into a recession, the United States.
Well, as you say, it's kind of interesting seeing the reaction that was prompted presumably by, what was really, I guess, Trump's pain trade, right, what was happening in treasuries. Does that give you more confidence in terms of pivoting to the markets that the US has targeted, Europe, China, for example? Where do you see the diversification opportunities there now?
There are lots of good diversification opportunities because in those places, the authorities are starting to stimulate, and once again, to make a positive out of a negative. I read somewhere, I can't remember who said it, I'm sorry, I can't give them credit, that Donald Trump and Vladimir Putin were the best thing that could have ever happened to Europe, because they've shooken it out of its torpor and lethargy that it's been in for the last couple of decades. And so there is lots of good value in Europe, and now it seems like next year there's going to be some growth there too, with Germany starting to stimulate its economy, and it has the resources to do that. And there's lots of things that Germany can spend on which will not be wasteful spending. They actually could use a lot of new infrastructure, and of course they'll be increasing their defense spending as well. And in China, there's lots of room to stimulate the economy. And in other parts of Asia as well. So yes, there are things to do around the world, but what I have to say is, to the extent that the S&P 500 is the benchmark for the world, that index, we believe, is in a bear market, and I highly suspect it'll be lower at the end of this year than it was at the beginning of this year. And so that acts as a weight on risk assets generally.
Yeah, especially for countries perhaps that are not really headed towards the easing path, like Japan, which is an anomaly sort of among advanced economies. There was a lot of optimism about Japanese equities, but could we continue to see that trend even when the BOJ is trying to normalize policy at a time when the external environment is so uncertain?
Yes, that's a very complicated situation, but I would say that I like Japan because within Asia, it's the only country that has really top quality global brand names, and the overall return on equity of Japan is very low. It's less than 10% because it's dragged down by conglomerates and banks. But because it's such a big market, over, I believe, 7,000 listed companies, something like that, you can construct a portfolio of a dozen or more very high-quality global brand name, large and liquid companies with returns on equity in the high teens or 20s. And that's the way I would approach Japan, because it does have these really high-quality companies that I don't mean to be nasty about the rest of Asia, but the rest of Asia doesn't have that.
Mm-hmm. What about China? I mean, you mentioned earlier that Europe was really shaken into action because of this sense of crisis. Could we actually see Beijing now trying to really boost the economy and that stimulus measures really filtering through the stock market? But on the other hand, of course, you have all of this pressure coming from tariffs.
Yes, I think so. Well, the major Chinese industries are still well below their all-time highs. And when I say well below, I mean, 30, 40, 50%. So they're not expensive. The Hang Seng Index still has something like a 4.5% dividend yield. You don't pay taxes on dividends, by the way, in Hong Kong. And I think the major thing was DeepSeek back in January, not only because it proved that China can operate at the forefront of high technology globally and offer very competitive products. But the government's response to that, I thought, was very good in that it had kind of been keeping the big technology stocks in the doghouse since Jack Ma's infamous speech a few years ago. And it's clear now the government views the big technology companies and technology in general in China as a positive force, as a soft power for the world. So I think that mending of fences between government and big tech in China is also very important.
Yeah, we'll be watching that market when it opens later this morning. Mark Matthews, head of Asia research at Julius Baer. Always good to have you with us, of course, on a day when we're also weighing that exemption on consumer electronics when it comes to tariffs coming from the White House. And right now we're seeing that broad upside on those semiconductor names. Tokyo Electron here in Japan also gaining ground more than 4% at the moment, with the broader Nikkei now up about 2%. And this, of course, after losses and just seesawing of last week when it comes to the Japanese yen as well. We continue to see a little bit of downside on the yen, but this after strengthening towards that 143 level against the U.S. dollar. And we continue to get the lines from the Singapore Monetary Authority as well. Do keep an eye on Singapore later for today, because we are now seeing MAS talking about the prospects for global trade and GDP growth really dimming earlier in April. This is Bloomberg.
We certainly need to have semiconductors and the downstream electronics supply chain move to the United States. What happened is, it's not really an exception, that's not even the right word for it. What happened is this type of supply chain moved from the tariff regime for the global tariff, the reciprocal tariff, and it moved to the national security tariff regime, where we have studies ongoing for pharmaceuticals, for semiconductors, metals, etc. So it's not that they won't be subject to tariffs geared at reshoring, they'll just be under a different regime.
In the 15 years after China entered the WTO, real wages went down. So wages went down by more than prices, as we thought these cheap goods were going to revolutionize America. In fact, it was the opposite.
The Trump team doing the media rounds in the U.S. after the president said a tariff exemption on electronics was only a procedural step. Let's get the latest with Bloomberg News desk editor Jill Deasy. Jill, so what is going on with these electronics goods tariffs? Because now we're hearing that they're coming, they're just in a different bucket of levies.
Yes, that's right, Shery. And I think that this is the kind of example that just shows you ultimately how broad and, sort of overwhelming these tariffs can really feel at times. So essentially some of this confusion, I think, originated from the U.S. Customs and Border Protection late Friday night, posted, this notice about these semiconductor tariffs, sort of interpreted as an exemption from the broader 125% or, higher China tariffs that are in existence. Well, now, obviously, what you've just heard there from the Trade Representative James of Greer is that that's not really technically what's happening here. There is a reprieve, in some ways, a pause on tariffs for semiconductors and related components and stuff like that. But that's really only because they're working out how to put those types of products under a sectoral tariff. So this is actually quite similar to what Trump has already done with tariffs on the auto sector. It's what he's doing with steel and aluminum tariffs. It's what he certainly talked about doing with the pharmaceutical sector. This idea of sort of partitioning that out from these broader nation-by-nation tariffs that, we've obviously been talking about for the past several weeks now, and instead focusing that on a more specific industry. I think we've heard, from some within Trump's orbit during that round on the media that, they're very concerned about not letting technologies get into China's hands in particular. And so that's where that kind of comes in. Again, I think probably leading to a little bit more confusion this week. We've already heard from China, sort of saying that the reprieve was the right step. Well, we'll see what we hear from them today once everybody starts to wake up and there's a little bit more clarity about these types of exemptions that these chips fall under.
We've seen some relief, particularly with the likes of Apple, right? Things were looking pretty dire if they were expected to shift their manufacturing base. What are we looking at in terms of, I guess, some of the winners stateside from these exemptions, even if they are sort of temporary exemptions that we know of?
Yeah, I think that at this point, really those big suppliers, those companies like Apple, that's what you would think in terms of a potential winner. But again, it's just so difficult because, if this is only a pause and we're still waiting to see what exactly a semiconductor-related sectoral tariff looks like, that really kind of changes the game here, right? So, maybe it's, these particular parts in China aren't subject to this 125%, 145%, those types of tariffs that have been put on China so far. But the fact of the matter is that if you've got something that still indicates, these higher levies that are coming into effect that are affecting, those flows of goods, that is going to play an impact. So maybe you get a little bit of a pause. Maybe you get a little bit more time for companies like Apple to shift maybe some, completed products, out of China. But in the end, it still does kind of underscore the fact that, we still haven't gotten a complete reprieve, honestly, from, all of these other country tariffs, for example. We've still got 90 days that we're trying to see how the Trump administration negotiates with other countries. We still need to look at what these sectoral tariffs look like. Trump has made very clear that his tariff regime is here to stay, and I'm not sure that, it's, people may be breathing a sigh of relief at the moment, but that certainly is very temporary.
Perhaps more of a shallow sigh of relief there. Bloomberg's Julius is there with the latest. At the moment, of course, we have seen the sort of charm offensive or the outreach when it comes to Beijing as being part of its efforts to try and solidify its own economy, its own non-US trading links. In light of this trade war, we're seeing President Xi Jinping ahead of a state visit to Vietnam, and particularly addressing sort of one of the markets that have been so heavily hit when it comes to these trade tariffs. In an article entitled Building on Past Achievements and Making New Advances in Pursuit of Shared Goals, Xi talks about protectionism not being the solution, that there being no winner when it comes to the trade war, alluding to China and Vietnam stepping up supply chain cooperation, properly managing their maritime dispute, as well as calling on the maintenance of global supply chain stability as well. That's been published in Xinhua media. Let's bring our Chief North Asia correspondent Stephen Angle joining us now. We've seen this is kind of one of the threads of what Beijing has been prioritising, which is to kind of really fortify these trading and strategic links, right? Even with countries like Vietnam, where, of course, there's been other areas of sensitivity.
Yeah, so let's talk about the Xi trip first. He heads to Vietnam today. He'll be there today and tomorrow, followed by Malaysia and then Cambodia. And these are three economies that got hit hard, essentially, with those Trump tariffs before the delay, the pause was put in place for 90 days. Vietnam with a 46% tariff from the White House, Cambodia 49%, and then Malaysia, I believe, was about 24%. And also it dovetails as well with the Apple story, because Vietnam and Malaysia are key assemblers of Apple products, mostly Macs, iMacs and the like. So it's all interrelated, and it's not a coincidence that Xi Jinping heads to Vietnam today, try and shore up what has been, let's face it, a fairly bumpy relationship historically between Vietnam and China. I think Beijing sees a definite diplomatic and economic opening here with these key Southeast Asian economies. Cambodia, there's already tons of Chinese investment in Cambodia. So that is at the end of the trip. They can shore up that partnership going forward. But clearly, China is digging in its heels in relation to the Trump tariffs.
As we're speaking right now, we're also hearing from the Japanese Prime Minister Shigeru Ishiba saying that they cannot just make continuous compromises in U.S. negotiations. Really interesting, the shift in tone when it comes to negotiations with Washington, something that we've already seen, Steve, from Beijing, where they have vowed to fight to the end. What's sort of the tone that we continue to perceive from Beijing policymakers at this point?
Well, the Chinese leadership is open to talks, but they want talks with the United States that are fair and also based on mutual respect. That has been a common theme in some of these statements. But we did get yesterday a statement from the Ministry of Commerce, MOFCOM, essentially saying this exemption, which we now have been clarified by Howard Lutnick as more of a recategorization of the computer products. Keep in mind, of these products, smartphones, laptops, and lithium-ion batteries are among the most traded items from China to the United States. So there was a bit of a relief, and the MOFCOM put out that statement yesterday saying it's a small step by the United States. This is with the exemption, if there was an exemption that was rumored about on Friday. A small step by the U.S. toward correcting its wrongful action of unilateral reciprocal tariffs. Well, now that we know that semiconductor and other computer-related products is not being exempted, it's being delayed, if you will, recategorized. We don't know what that tariff ultimately will be. And we don't know, of course, as the work week begins in Beijing today, if there will be further clarification of MOFCOM. But they did also go on to say the tariff action from the United States is a joke, and it no longer is worthy of any further reciprocal action by Beijing, because the whole tariff regime is a joke in their estimation. So, again, like I said earlier, Beijing is digging in its heels. It's open to talks, but has to be on a fair basis with mutual respect.
Our Chief North Asia correspondent Stephen Engel, as we continue to watch the market reaction to what's happened over the weekend when it comes to those electronic goods and the U.S. tariff exemption. Take a look at how European futures are also gaining ground at the moment. And we have seen Europe become a big target for President Trump. And European stocks have fallen for the last 3 weeks already as this trade war continues to rage across the world. We're seeing Euro stocks 50 futures, though, today to the upside of 2.6% as the euro holds steady. This is Bloomberg.
Here, 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
The year progresses, markets will calibrate further clarity on trade policy against the tax and deregulatory pillars of the agenda as the U.S. endeavors to rebalance the fiscal equation and assert the national interest. Given this unpredictability, some clients are deferring strategic activity while others are proceeding.
We also support the administration's willingness to look at barriers to fair trade for the United States. Though there are certainly risks associated with such significant actions, and we see concern playing out in the markets and the economic uncertainty that now exists. Timely resolution which benefits the U.S. would be good for businesses, consumers, and the markets.
CEOs of Wall Street's biggest banks during their earnings call on Friday. And of course, no sooner are we sort of still contending with the uncertainty and chaos over tariff policy. We're also looking at the start of earnings season, right, as well, in particular when it comes to the bank earnings that we're looking ahead to. It is looking like a period of consternation more broadly when it comes to this earnings season for traders, with almost that downside now expected, right, just compounding the uncertainty when it comes to these trade tariffs. But when it comes to the banks in particular, this is how we've seen kind of the trade. JP Morgan Chase up by 4% there. We're seeing a little bit of upside there for most of these big banks except for Wells Fargo, which of course has sort of more idiosyncratic issues when it comes to that lender in particular. But a lot of uncertainties when it comes to US financials and banks at the moment. And the JP Morgan sort of position is looking sort of strongest, given that we've had record revenue for trading in particular. Morgan Stanley also pretty well placed when it comes to really estimate beating numbers in the past.
And of course, at a time when we're getting a lot of earnings from Asia as well, we'll be watching CATL, for example, in China. I mean, despite battery prices really decreasing, we are expecting some positive net income numbers of gains of more than 30%. We're also watching Indian IT firms, Infosys, Wipro. They're expected to get hit by the tariff concerns, a slow global economic growth. But TSMC very closely watched because sentiment's still positive given the 90-day pause right now on higher tariffs. But of course, the implications for supply chains are pretty big at the moment. This is Bloomberg. Take a look at how we're looking early in the Asia trading session. Of course, we are seeing that broad upside from that reprieve that we got on those U.S. tariffs on electronics goods. So you can see the Nikkei now gaining 2% as the Japanese yen is also strengthening against the U.S. dollar towards that 143 level. But what we're watching very closely are those semiconductor names also in South Korea, Samsung, SK Hynix gaining ground. And of course, the offshore yuan at the moment also trading steady at that 729 level. We'll be watching the market opens after 4 weeks of losses for the yuan. We also got the Monetary Authority of Singapore really easing policy and talking about the downside to the economic growth outlook given everything that's happening externally. Let's actually go to Singapore and delve a little bit more on the global trade war's impact on supply chains and businesses. Inside anchor Hasinda Amin is standing by in our studio there with our next guest, Has.
That's right, Shery. Suffice to say, global supply chains are getting tested already. We're seeing how freight orders have been delayed, been cancelled because of all the uncertainty. Let's get insight from one company that's right smack in the center of global supply chains. DHL CEO Tobias Meyer is with us. Tobias, good to have you with us. We've been talking about how, electronics have been exempted, at least for now, the 90-day delay. How much reprieve really is that giving to trade?
I think, Linda, we need to see what now is really happening. Obviously, there are certain goods that have been in transit, and for those companies, for those customers of ours, this is a big relief. It is a bit unusual that the relief was retroactive, so backdated to April 5th. So there's also now some work to be done with customs in terms of rewinding this. What's going to happen going forward is very uncertain. We heard those comments from the President of the United States earlier that they are looking now at electronics from a different angle of security, national security, the Section 232 of the U.S. Code. So I think for our customers, there's still a lot of uncertainty out there.
Yeah, the thing is, tariffs are coming. It just depends on how high they are. I'm just wondering, in terms of activity, are you seeing customers front-loading exports? What are you seeing?
I think in the last wave of tariffs being announced, that was not as big as we expected it, and as we've seen it in the past. I think people are getting really a bit tired. They don't know, even if something's announced, whether 2 days later it's not changed again. So you really see some fatigue of decision makers in manufacturing and also in the distribution sector.
Where's the pain being felt the most? Is it in the U.S. market?
Well, what we've seen is when in February the de minimis was gone, those shipments under $800 that currently don't require formal clearance, don't attract duties and taxes at all when it comes to imports in the U.S. When that was gone, the number of entries that Customs and Border Patrol had to process basically doubled overnight, and that was a real operational hurdle. I think now it's more customers, manufacturing companies trying to figure out where to put production, where to put inventory to best position themselves, and that's something that's very difficult to do.
So what are some of the considerations? Where are they thinking? What might it look like?
Well, I think there is the consideration what the administration of the U.S. is going to factor in. So whether they clearly they have the consumer in their mind. They don't want to see a big product launch being delayed, for instance. So that seems to be part of the calculus. It's very hard, though, for our customers to figure that out. So I hear a lot that customers simply say, we'll wait for now.
I love your website because you were trying to explain to your customers how to deal with the uncertainty. But you have decided to actually open a pharma hub in Singapore, right? At a time when we're also hearing from Washington that pharmaceutical tariffs could come in a month or two, according to the Commerce Secretary. So how are you positioning and how does Singapore play into that?
Well, Shery, we have a clear strategy laid out for 2030 where we want to invest in several growth vectors, and life science and healthcare is clearly amongst that. So we see that as a secular trend, and we want to stay on that. We also have to bear in mind when it comes to global trade, 75% of global trade has nothing to do with the U.S. It's not U.S. inbound or outbound. So that continues to grow, especially the trade in Asia grows. And this is why we're doubling down on those areas. Life science and healthcare, and Asia is top of our agenda, and the Singapore investment absolutely fits into that.
Not only Singapore, but I heard at one point you were trying to hire more in Malaysia as well, given, of course, the ongoing trade ramifications in the United States. How will this really affect your business performance and where you allocate more hiring and perhaps even layoffs in the next few years?
I think that's hard to say. Again, there are some areas that see structural growth. A third of our revenue by now is related to e-commerce, for instance. We have a leading position when it comes to the international transport, warehousing and distribution of pharmaceuticals. So those things, those sectors, we continue to heavily invest in. When it comes to the more short term, the capacity sizing in our hubs, for instance, how we deploy aircraft, that is something that we in these days need to handle on a week-by-week basis. We have significant airlift capacity in our DHL Express network, and this is hard work to redeploy those assets to make sure we can offer the transportation capacity where it's needed.
Tobias, you got to wonder, are there now more disputes about who will pick up the tariffs, who will pay the cost, the additional cost that we're expected to see?
Well, firstly, I'm worried about the decision-making being delayed, and that, those investments not being made, that will lead to some shortages somewhere at some point. So that's a negative for the global economy. I think that's clear. As it relates to the consumer, Linda, we have to see. The American consumer has been quite robust when it comes to these clear signs of volatility. Now, a lot is still to be seen when fashion now really becomes more expensive in the U.S. That's not a critical item, so people might just reduce. When it comes to more industrial goods or also consumer electronics, that is hard to substitute. So a lot of uncertainty, also for us, hard to see how these trade flows are going to develop.
In the end, consumers will pay a higher price, though. That's the assumption.
Of course. I mean, if you charge an additional tariffs or taxes, they need to be paid by somebody, and that's the consumer ultimately. Now, whether this is offset by other measures, tax reliefs, is to be seen. But clearly, this is an additional burden on the U.S. consumer.
In the broader scheme of things, I continue to hear the uncertainty about your prospects, from every business leader that we speak to, but perhaps mostly when it comes to logistics company, to DHL in particular. When it comes to really trying to map out a broader vision for the next few years, does that affect some of your targets? Like last year, you were talking about a 50% rise in revenue by 2030. Would that affect it?
No, Shery, we remain quite bullish because we have a higher market share in the 75% of global trade that are not related to the U.S. Traditionally, our market share in and out of the U.S. is relatively low. We have domestic activities that are very strong in the U.S., which we don't think will be much impacted by this. And again, we have growth sectors that we believe will continue to deliver good growth. The energy transition is fully going on in the rest of the world. Wind turbines, solar cells and panels need to be transported. E-commerce continues to be a secular trend. People buy more online. They don't want to spend that much time in the shops. That's a global phenomenon. And that's what we as DHL focus on. This is why, yes, the changes in U.S. trade policies are tiring for all of us. It's clearly a key agenda item on the day-to-day. But as it relates to the midterm growth prospects for DHL, I'm not worried.
But how do you make forward planning? I mean, there's so much uncertainty. How can there be clarity and for you to come up with, the numbers and the projections ahead? And linked to that as well, Tobias, I'm just wondering, are you in a war footing? I mean, do you wake up every morning, gather the troops together and reassess, discuss what's the strategy ahead? Because there's so many changes on a daily basis.
We stay calm on this. We have operational colleagues who have a very busy day, and I'm glad that they get up every morning and tackle the challenges that we have in clearing shipments into the U.S. for our customers. So that is clearly a very intense time for those colleagues. But as it relates to the fundamental trends that we're trying to take benefit of, people in Asia are going to age. There's great progress when it comes to pharmaceuticals, and that leads to a combination that requires better logistics, more cold chain logistics for our pharmaceutical customers. And that's not going to change because of your trade policy.
Keep calm and carry on, Shery.
Tobias, we actually really sympathize with you when it comes to what you call these exhausting tariff news. But DHL CEO Tobias Meyer making the time to join us together with Inside anchor Hazinda Amin. Thank you.
Well, amidst the ongoing tariff strike, Goldman Sachs has cut its China stock index targets for the second time this month. The MSCI China Index 12-month target is now 75. Our Asia Equities Managing Editor Lian Ting-tu joins us now for more as we take a look at the markets ahead in China and Hong Kong the next hour. We're seeing some strength when it comes to a little bit of uptick when it comes to trading at the moment, and markets are already open, and US futures, of course, as well. But it's interesting, the downgrade from Goldman Sachs. It seems like for every person who is pretty down on the forecast for China, there are others that look at markets like China and think it's a good diversifier, and they actually have positive expectations in terms of a policy response from Beijing.
Yeah, I think today's China market open would potentially be a bit buoyant, judging by the overnight session on Friday from the likes of Golden Dragon Index and a few other Chinese ETFs. So I think Goldman's call came, of course, amid the whole, escalation of trade tensions between China and the index, and China and the US. They're really talking about concerns of a global recession and the further decoupling between the two of the world's largest nations. So yeah, it is second time of a target cut in about 2 weeks' time. And if you look at Bloomberg Intelligence, they're also doing their calculation, and the conclusion is not too far off from what Goldman just said. So BI is saying that a potential US recession could drag the China index by about 11%, and then can shave China's GDP by potentially 3 percentage points.
Lian Ting, we continue to watch, of course, tech stocks across Asia, seeing this rally in today's session, given the reprieve that we're getting from Washington. But I wonder what the reaction might be from the Chinese markets in these tech names that led the rally earlier this year, but as the trade war between Beijing and Washington continues.
Yeah, I think China has a lot of Apple suppliers, so that sector will definitely be in focus. And Apple, as you guys reported over the weekend, it is getting a temporary reprieve. We don't know what Trump is going to announce on Monday, but I think net analysts are saying today is going to be a positive day for Apple suppliers, for NVIDIA suppliers, for overall chip makers, because they will potentially get a bit of a pause in tariffs. So yeah, we have quite a few onshore listed Apple suppliers that we're probably going to expect a bit of a 10% limit up for some of those names. And if you look at Japan and Korea, those chip makers or chip related companies are right now leading the gains in the MSCI Asia Pacific Index.
Bloomberg Asia Equities Managing Editor Lian Ting-tu there. More ahead on the Asia trade. This is Bloomberg.
As U.S. tariffs cloud the outlook for global activity, Singapore's central bank has eased policy and cut its GDP outlook for the year. The MAS downgraded its growth forecast to between 0 and 2%, down from 1 to 3%. Bloomberg's Avril Hong joins us now from Singapore. And Avril, really not that surprising given how externally vulnerable this economy is.
Yeah, it's a very open economy. If you look at trade, it's a couple of 100 times its GDP. So given these tariff concerns, unsurprising that that's weighed on the growth forecast for MAS this year. As you say, cutting it to 0 to 2%. And this is, for context, after 4+% growth just in 2024 for the full year, and already missing the mark in terms of the first quarter scorecard. For Singapore in particular, not only is it going to have to grapple with 10% levies from the US, think as well about how, in terms of the risk of potentially how that can impact trading activity. That could also have knock-on effects for its finance, insurance sectors, and manufacturing and trade-related services. Those are also sectors that are in the spotlight that could take a hit given these tariff risks. Now, the concern also that
this is an election year, and amid all this, cost of living concerns still weigh heavy in the minds of voters. All that being said, the good news is that core inflation, the forecast for it has also been brought down. So the central bank does see a more benign outlook overall. And amid all this, despite what tariffs could mean for inflation, MAS says imported and domestic cost pressures will remain low. So what it's done this time around, reducing the slope of the currency band, seen as the more less aggressive of the options in terms of easing for MAS.
What do we see as the impact on the Singapore dollar? Do we see the valuation gap narrowing, perhaps?
Yeah, Singapore dollar, that's interesting because for much of this year, it's managed that outperformance. I think it's only second in terms of the outperformance versus other Asia FX, second only to the Japanese yen. And last week also, amid all the currency volatility, you actually saw it managing to reach a 5-month high at one point. It's a bit more nuanced of a picture from here on out. We have our Bloomberg economists already expecting more easing from the central bank, given this cut to growth outlook. They see it in July and October when the MAS next meets, but also nuanced because of the greenback slump. Some of our strategists have highlighted that despite all this, the Sing dollar can still outperform because if you look at the currency settings, it's still looking at appreciation bias for the Sing dollar versus other currencies. That's the setting that the MAS is deploying. And don't forget also a sort of safe haven status that the Sing dollar enjoys. So expected outperformance continued.
Avril there with the latest when it comes to Singapore. Of course, one of the truly externally open and vulnerable economies, the middle nations that are now grappling with how they respond to this ongoing trade war. Take a look at US treasuries. And of course, this is particularly interesting when it comes to just how we've seen the reaction across the treasury market as well as just broader sort of dollar-denominated assets. But it does feel like perhaps this is one of the reasons why we have seen a little bit of a step back from President Trump on that tariff exemption. Of course, he has now come out and clarified it's not so much an exemption, but just a procedural step that they're taking a closer look at chips and the whole supply chain, and that those tariffs are still forthcoming. But we have seen that move when it comes to treasuries, particularly on the longer end of the maturity spectrum, the decline that we've seen in treasury futures. And of course, we saw a loss of about 2.5 last week, the biggest slump in Treasury since 2001, according to Bloomberg data. Well, while China is now dismissing President Trump's tariffs and trade war as a, quote, joke, Bloomberg opinion columnist Shery thinks that Beijing could also use its massive holdings of US debt as a weapon in this trade war. Shery joins us now from Hong Kong. Shery, this was truly be a nuclear option, right? And we've long kind of dismissed it because of the adverse effects that China would face in doing that. What is the logic here? Because we've seen unprecedented, obviously, policy moves from the US, and so this kind of gets thrown back onto the table as something that we should probably talk about.
That's correct. I'm not sure Donald Trump understands the art of the deal, definitely not the art of the war. His chaotic policy making last week basically exposed his weakness and his choke point. He blinked after practically admitting that he didn't want to see the U.S. bond sell-off to continue. And in addition, these days, Treasury Secretary Scott Bessent is spearheading the tariff negotiations. And we all know that Bessent cares a lot about the Treasury yields, right? He said that the 1 basis point rise in Treasury yield will cost the U.S. government $100 billion. And he calls himself the biggest bond salesman in the U.S. And that's why you can see everyone knows that the U.S. Government bond is the government's pain point. And over the weekend, Japan came out saying that they're not going to weaponize that. So this is no secret. And I don't think China will shy away from that at this point.
It was no secret during the first Trump administration as well. I mean, I remember asking the Chinese ambassador to Washington back then if using treasuries was on the table. He said that everything was on the table, but then that news sort of petered out during the course of Trump's presidency. So is anything different from then?
Since Trump's first presidency, the PBOC has been diversifying its foreign reserves. In the last 5 months, for example, it has been buying gold. And that's why last week when news came out that China was buying gold for the fifth straight month, gold rallied and the US dollar tanked, right? Because China, after all, is a big mover in the US dollar market. And in addition, it has been diversifying into other currencies, because at the end of the day, if US wants to become an economic island, why do we need to hold a US dollar? So it has been diversifying from gold and US treasuries.
Yeah, Beijing has been preparing now for years. Bloomberg opinion columnist Shery Ren, good to have you with us. We have more ahead on the Asia trade. This is Bloomberg. Take a look at some of those stocks that we're watching early in the Asia session as we await the market opens in China. Apple suppliers rallying, global tech rallying at the moment after we saw, of course, that exemption coming from President Trump when it comes to that range of electronics from 125 tariffs on China, 10% flat rate around the globe as well. Although President Trump did put the caveat on Sunday that he will eventually apply all of those tariffs, that this is just a procedural step and that they will actually go in a different bucket of potential tariffs. So for the time being, though, Haidi, we continue to watch all of these names that could see the broader rally together, because Japan is rallying, Korea is rallying, a lot of those semiconductor names are rallying. What will happen to those Chinese stocks is a question, because at the same time, you continue to see Washington and Beijing really ramping up the narrative.
Even with an exemption that maybe isn't an exemption, there's no certainty when it comes to this frenetic pace of policy making, right? As you mentioned, it is really kind of watching to see what the reaction is from Beijing, given that they've really said we're no longer going to go tit for tat after these levels. But we've seen some meaningful implications when it comes to Goldman Sachs cutting their targets for China stocks for a second time in April. Again, heightened trade tensions being the reason. We're also still on the watch when it comes to any moves on a PBOC rate cut and RRR. We get trade numbers out today, as well as that domestic activity data out this week as well. This is Bloomberg.